There are moments in history when silence speaks louder than words, when markets do not shout, but whisper, when green candles flicker not as fireworks, but as beacons in the fog. This is one of those moments. 3 consecutive days of green. Not a rally, not yet, but not a coincidence either. What we are witnessing is not a climax, nor a conclusion. It is perhaps a prologue, a new chapter written not in headlines, but in subtle shifts, in whispered signals, in cautious optimism. The world has changed so often, and yet, the market remains the great mirror. It reflects our fears, our hopes, our errors, and our resolve. And right now, that mirror is reflecting a question that echoes through every portfolio, every strategy session, every quiet moment before the opening bell. Have we turned the corner? Or is this simply a temporary pause in a longer descent? To answer this, we must look deeper, beyond the tickers, beyond the price charts, beyond the breathless headlines. Let us return for a moment to the beginning. The markets have been weary, beaten down by inflation concerns, by global conflict, by the endless dance of rate hikes and recession fears. Retail investors have watched nervously as volatility returned, not with a roar, but a steady, grinding presence that eroded confidence, one session at a time. And then came the tariffs. What began as a geopolitical strategy soon became an economic weight. Supply chains, already fragile, were strained. Corporate guidance turned vague. Plans were shelved. Growth projections sliced. Yet here we are. The weight is still there, yes. But something else is happening. The market, in its timeless way, is beginning to adapt. The sell-off that began in uncertainty has given way to something more strategic. And now, after 3 days of gains, the whispers begin. Not shouts, not yet, but whispers. And that is often how real momentum begins. Market technician Thomas Hughes has captured this transition with a concept he calls the 3Ds: de-escalation, delay, and deals. Let us explore these pillars. The first, de-escalation. While no formal peace has been declared, the tone between global powers has softened. Tariffs, though still looming, are being discussed behind closed doors with growing urgency. The second, delay. Deadlines and policy decisions, once seen as immovable walls, are now being extended, buying time. Time for markets to stabilize. Time for sentiment to recalibrate. The third, deals, signals, however faint, have emerged, suggesting that trade partners are not just posturing, but positioning. Positioning to negotiate, to compromise, to move forward. If these trends solidify, we will not just see relief. We will see reacceleration. An earnings season has arrived right on cue. Early reports are not just good, they are better than feared. And in this market, that may be enough. ServiceNow, a name less glamorous than Tesla or Amazon, has become an unexpected bellwether. Why? Because its success speaks to something deeper: enterprise resilience, corporate willingness to invest in infrastructure, in automation, in AI. And if companies are still investing in efficiency, it suggests they are not retreating, but preparing. And what, then, of the Magnificent Seven? Their influence is immeasurable. In the age of artificial intelligence, cloud computing, and digital transformation, they do not just drive sectors, they define them. Tesla may have stumbled, but even that stumble is a lesson. It tells us that markets are watching not just performance, but leadership. That sentiment is not just about numbers, but about narrative. And Elon Musk, for all his genius, may be learning that the hard way. But the rest of the Magnificent Seven, Alphabet, Microsoft, Amazon, Nvidia, Meta, Apple, stand at the gates of a new quarter. And the expectations are high, not because the economy is booming, but because they are the economy now. What they report will not just inform investors. It will shape the very tone of the next 3 to 6 months. Because earnings, in their essence, are truth. They reveal where the money is going, where demand is holding, where cracks are forming, and where foundations are being reinforced. In this moment, earnings are more than numbers. They are a litmus test for belief, a test we are about to take. At the same time, macroeconomic signals continue to offer a mixed, but improving, picture. Labor remains strong. Consumers are still spending, even if more cautiously. Services remain robust, even as manufacturing lags. Is it perfect? No. Is it a recession? Not quite. It is something in between, a delicate, balancing act between risk and reward, between fear and faith. And so, the market responds not with euphoria, but with a slow, deliberate pivot. Momentum, once bearish, has turned bullish. Support levels are holding. Patterns are shifting. It is not a roar. It is a murmur, a footstep. But footsteps, when they multiply, become marches. And marches change history. So the question remains, not whether the market has bottomed, but whether you believe in the direction it's pointing. For those who wait for confirmation, the train may have already left the station. For those who jump too soon, the risks remain. But for those with discipline, with patience, and with a plan, this may be the beginning of something significant. The kind of inflection point that only becomes obvious in hindsight. And so, dear investor, we return to the timeless advice. Do not chase, but do not sleep either. Watch closely, move wisely, think long-term, because as the sun rises on another earnings report, another trade headline, another tweet that could shake sentiment, the market will do what it always does. It will move, and in its movement, it will reward the prepared. Not the perfect, but the prepared. So ask yourself, not what the market will do next, but what you will do. Because in this business, fortune favors not the bold, but the ready. And right now, readiness may be the greatest asset of all.